Welcome to the Brunsdon Investment Market Update. It's been a very interesting year to date with the Brexit vote and the way the markets have performed, and in particular the way sterling has devalued. We're very pleased to have with us today Mark Shields from Brooks Macdonald. Welcome, Mark.
Thank you very much, Brian. Thank you for having me.
Mark is one of the investment directors at Brooks Macdonald, who looks after over £9 billion worth of investment monies for clients. And we're very pleased, as I say, to have Mark with us today to add a little bit more and answer a few of our questions with regard to how the economy is performing at the moment and really thoughts for the future. So Mark, welcome, as I mentioned before. The Brexit vote and how it's affected markets at the moment, could you perhaps give us more of an overview as to why markets have performed as they are at the moment and your thoughts for the future, please?
Yeah, absolutely. I mean, obviously what happened in the immediate aftermath of the Brexit vote was a substantial correction within the UK markets especially. Subsequent to that, of course, we've seen markets rally particularly hard. I think this has come about due to a couple of different reasons. First of all, as you've already mentioned, sterling weakened significantly. And this has had a very positive impact on the larger companies that are listed in the UK, but many of which generate their earnings from overseas, typically in dollars. So when those dollar earnings are translated back into sterling, if sterling is depreciated, then it is very earnings enhancing. So it has meant that those larger companies that are listed in the UK, but actually a lot of their operations are overseas, have performed exceptionally well. We've also seen a rebound within some of the smaller companies, which also were hit very hard post-Brexit. Even though these companies are more domestically focused, I think a lot of investors recognise the fact that the selling in the immediate aftermath of the referendum was overblown. And there are a lot of companies there were quality companies that could be purchased at a very good price. We've also seen some developments globally as well and also domestically. So I think markets didn't really expect the political situation within the UK to be resolved as quickly as it was. I think a lot of people were expecting at least 6 months of political turmoil, and in the event, Theresa May obviously became Prime Minister relatively rapidly post David Cameron. So I think there has been several key impacts on the UK market that have actually been driving the positive returns we've seen after Brexit.
Okay, and thinking a little bit further ahead, we know that Theresa May has called the Brexit vote to come into operation, so to speak, from early next year. How do you then see it playing out with regard to the UK's position within Europe going forward?
Yeah, I mean that's obviously a difficult question to answer, and it is one that we're going to be monitoring exceptionally closely. I think it's important to realise that there are an awful lot of political issues in Europe at the moment. We obviously have the Italian referendum towards the end of this year. We have French and German elections next year. We also have a Hungarian election to do or based around whether Hungary will agree effectively to take on the immigrants that have been arriving there, and that could almost be expanded out or construed to be a vote of confidence in the EU. So it's very difficult for us to really get a gauge on how Brexit and the wider political situation is going to affect Europe in general. What I will say is that from our portfolio perspective, we are underweight Europe. We feel that economically, Europe is not looking great. It's not looking terrible, but it's not looking great. But there's a big political risk overlaying that, and as such, we have decided to reduce some of our exposure to Europe, at least in the interim, and we shall see how the Brexit negotiations go and how the political situation in Europe develops over time.
We ought to talk about the USA. Now, having just been to the USA, it's a very interesting discussion, whether it's Trump or Clinton. So really the question is, if it's Trump or Clinton, how do you see that affecting investment markets?
Again, a very good question that is difficult to answer without a crystal ball, clearly. I think, again, that there obviously is this political question mark in the US. At the moment, even though the polls are broadly split, obviously recently they've been going a little bit more in favour of Hillary Clinton. If you look at the breakdown of the key states, the voting that's likely to happen there, markets are currently pricing in, or expectations are for a roughly 70% chance of Clinton winning. How do we translate that to our portfolios? Well, it's not something that we're going to be taking a big call on, because it's very difficult to really gauge what impact a Clinton administration would have over and above a Trump, or vice versa. And we'd clearly be exposing ourselves to quite a lot of risk if we were to, for example, sell out of the US completely. It's notwithstanding the fact that actually economically we think the US is in very good shape. However, I think that if we do see Clinton win, she may have some issues regarding the fact that both the Senate and the Congress, at least at the moment, are controlled by Republicans. So we could see a continuation of the lame duck type presidency that Obama was encumbered with. Conversely, if we see a Trump administration, certain sectors of the US market are likely to perform particularly well. Infrastructure, defense being two examples of that. However, again, it's a binary outcome. We're not going to be wading into one position or the other in order to try and exploit those positions. We're investing in the US for the longer term economic strength we think that the US can deliver, as well as the fact that we believe that the dollar will remain strong, at least in the meantime.
Right, okay. We ought to talk about the devaluation of sterling and how it affects UK inflation. What are your thoughts on that, Mark?
Yeah, obviously the devaluation of sterling would have a big impact on, or potentially have a big impact on, inflation within the UK. We've seen data coming out very recently that showed inflation in the UK has moved up to 1%. And indeed, most of the projections that we're seeing now suggest that inflation will move up to 3%, maybe even a little bit more in 2017, before potentially declining off again as that currency impact begins to abate. Why have we not seen inflation already? Brexit was several months behind. Partly that's because a lot of large companies hedge currency impacts, and a lot of those hedges are coming off at the beginning of 2017. So we think that actually the currency-driven inflation will likely pick up at the beginning of next year. But also there's another impact on inflation, which is energy. And we've seen the price of oil increase by roughly 37%, 38% since the beginning of the year, around about $51, $52 a barrel. And that again will start to feed through to inflation data throughout the rest of 2016 and 2017. So we do think that inflation is likely to increase within the UK, and obviously by extension that puts the Bank of England in a little bit of a bind as to whether they'll be able to maintain that 2% inflation limit. Okay,
so that all sounds reasonably steady as she goes type an approach to investments. But if you're looking, which is the $64 million question, of course, is if you're looking 12 months, 24 months, 36 months out, how do you see investment markets performing?
Yeah, I mean that is obviously the question, isn't it? Yeah. I think where we have our sort of base case at the moment is that we expect there to be a degree of stagnation potentially within asset prices. We have seen global markets, UK in particular, perform exceptionally well over the past few months, and portfolios indeed have performed particularly well over the past few months. We don't really expect to see those sort of returns continuing in the near term. And as such, we have started to focus a little bit more, or focus our portfolios a little bit more on yielding positions, whether they be large cap equity or global equity, or indeed corporate bonds, or alternatives as well, maybe looking at other parts of the investment universe where we can generate a reasonable yield. That means if we do see a bit of a slowdown within the global economy over the next 12 months, which is possible, at least we will be able to generate 3-4% from some of our equity positions in income over that period of time, and hopefully mean that we'll be able to smooth returns within the portfolios. We don't necessarily see markets racing ahead. We don't necessarily see markets collapsing. There may be short periods where markets do come off, and we would probably regard those as buying opportunities on a longer term time horizon.
Well, thanks for that, Mark. To me, it's a pretty positive outlook, rather steady as she goes still, but some great opportunities to buy probably coming up, and opportunities for you as investment managers to take profits as and when needed. And really, it all sums up what an active fund management approach is all about. So thank you very much for coming today.
Thank you very much for having me.
So there we are. It's very much steady as we go. It's very much about active fund management, which really is what the Brunston Asset Management Funds are all about. I'd like to thank you all for listening. I hope it's been of interest to you. If you have any questions or queries, as always, at any time, please be in touch with us here at Brunston. Be in touch with your usual Brunston consultant. And if you want to see the daily prices, please go on the Bloomberg links, which you will find on the website. And see you next time. Thank you.